Good afternoon, ladies and gentlemen. It is a great pleasure to be able to present today's proposal to you. It sets out the details of the financial transaction tax to be applied by 11 member states through enhanced cooperation. And in doing so, it lays the final paving stone on the road towards a common FTT in the EU, the first financial transaction tax ever to be implemented at regional level. What we have proposed is an unquestionably fair, technically sound, and legally robust tax. A tax which will strengthen our single market and temper irresponsible financial trading. A tax which will deliver an estimated 35 billion euros a year when implemented by the 11 member states in question. As clearly requested by the 11 participating member states, the Commission stuck closely to our original FTT blueprint when drawing up this proposal. This means we kept the low rates of 0.1% for shares and bonds and 0.01% for derivatives. We maintained the wide base covering all financial institutions and all financial instruments. The real economy continues to be protected as we ring-fenced ordinary financial activities of citizens and businesses, as well as activities linked to raising capital. Transactions related to monetary policy, refinancing, and public debt management are also outside the scope. Finally, the solid safeguards against relocation of the financial sector from the participating states are not only preserved from the initial proposal, but reinforced. In terms of changes in today's proposal, compared to that which I presented in September 2011, there are just a few. And each of these changes has been introduced for a valid and rational reason. Either they give more legal certainty to the text, for example, by clarifying the definition of financial institution and explicitly excluding the ECB, EFSF, and ESM from the scope. Or they reinforce anti-avoidance measures, for example, by complementing the residence principle we had already envisaged in the last proposal with the issuance principle. Overall, this would mean that any transactions would be taxed as long as there is an established economic link to the FTT zone, be it through parties to the transaction or if the traded product was issued there. Such provisions provide strong protection against relocation or avoidance for the member states applying the FTT. It also preserves the non-participating member states from any adverse impact on their rights and obligations under the treaty. Ladies and gentlemen, 11 member states called for this proposal I have presented today so that they can move ahead with the FTT through enhanced cooperation. I now call on them to continue to push ahead with this ambition. This would respond to the long-time demands of our citizens who have long understood the benefits that a harmonized approach on the FTT can bring. Every procedural step to facilitate an FTT through enhanced cooperation has been met now, and nothing stands in the way of its implementation. I now hand over to the 11 member states to drive, decide, and deliver on this harmonized financial transaction tax. Thank you.
Thank you, Commissioner. I now give you the floor for any question. I have Gabriele and Bruno.
Hi, Gabrielle Steinhauser from the Wall Street Journal. Mr. Commissioner, last night the US Treasury came out and said they in fact do not support a European financial transaction tax. and it seems like several U.S. investment funds and investment industry groups are already sort of preparing legal action. How concerned are you, and what have your interactions been with the U.S. Treasury on this tax?
Well, so first of all, I think that the proposal which we just made is fully compliant with international tax law and international practices. The principles, the residence principle and the issuance principle are widely used in international taxation practice, and actually the only transactions which have an economic link with the territory of the participating member states, so-called FTT 11, only those transactions will be subject to tax. So that means that we fully respect the territoriality principle with our proposal. But of course, I will be more than happy to discuss with U.S. authorities. And next week, I'm going to United States to meet, to have meetings with various interlocutors, and it will be a very good occasion also to discuss this issue with U.S. authorities.
Bruno?
It's a related question. You must be aware that other financial transaction taxes, such as stamp duty, in Britain exists alongside double taxation agreements in order for it to work with the residency principles. Are you going to negotiate a double taxation agreement with the US? If you do negotiate a double taxation with the US but not with non-FTT countries within the EU, are you not then establishing a discriminatory principle at the heart of a single market?
Well, first of all, I think that I have to be very clear that FTT introduced by 11 member states will eliminate any possibility of double taxation among those 11 member states. And we should remember that any member state has a right to introduce taxes on its own. And there are already several member states in EU which have one or another form of financial transaction tax. And without existence of enhanced cooperation, of course, nothing prohibits the member states to introduce financial transaction tax on their own. And as far as I know, some participating member states, like Italy, like Spain or Portugal, they are considering possibility to introduce this tax in their countries. So regarding the potential double taxation with non-participating countries, in this case we would have some member states and third countries. Of course, this issue will have to be discussed during the negotiations in the Council. And today probably it would be premature to say what will be the final outcome of this discussion.
Mm-hmm. You had a follow-up question, Bruno? Yes?
So you do accept that your FTT will lead to double taxation. So, for example, a transaction on the London Stock Exchange could be taxed twice. It could be taxed in the UK, and it could also be taxed in the FTT 11. Do you think that is a helpful? Do you think that is a helpful move? And will you take measures to avoid double taxation? Do you see it as a problem?
Well, I think that we have to look at the very concrete situations, and I would like to just remind you that A few years ago, several member states, including United Kingdom, they introduced their own bank levies unilaterally. So there were around 10 member states who did so, and that led to the problems with double taxation, which are not finally resolved up to now. So in this particular case, what we ensure that this tax will be introduced in the group of member states where, at least in this group, the double taxation problem will be avoided. And if this problem arises with some other countries, then one has to look at the specific situation with the specific country and then to decide how to address this problem.
One or two questions more, maybe?
Olaf Christensen, Danish television. Commissioner, could you explain to us, say we have a situation where two banks in non-FTT countries make a transaction. Say it's a Danish bank which sells a German T-bond to a Swedish bank, and it takes place, say, at the Copenhagen Stock Exchange. How are you going to make sure that the money is actually collected and transferred back to the FTT zone?
Mm-hmm. We have a well-established system of cooperation in the EU. We should not forget that we have this system of Directive on Administrative Cooperation, which entered into force just from the 1st of January this year. We have the Directive on Mutual Assistance in Tax Recoveries. And these directives actually, they ensure the strong cooperation between member states. Of course, member states, participating member states, they will have to develop their tax collection methods. And in the proposal for the directive, we propose also implementing act which will deal with the issue of the collection in order to ensure coherence of the tax collection among participating member states. And in terms of experiences, so we have many experiences in various tax areas, and FTT is not something very new in terms of overall tax experiences. For example, in case of VAT, we have the system when, for example, if Belgian customer buys software from American company, so that American company has to pay tax according to the Belgian law. And there are also the systems how to collect this tax. So these experiences, of course, will be used also in implementation of our proposal.
The final question, yes?
Well, it just sounds like you're relying on a degree of cooperation with non-participating states that, I mean, probably hasn't been assured yet. Say Denmark and Sweden.
Well, administrative cooperation is governed by EU directive, which was agreed by all 27 member states and which had to be implemented by all 27 member states. It's an EU law. And the same is applicable also to the directive on mutual assistance in recoveries, which is also EU law. So all 27 member states, they have to implement the provisions of this legislation.
Sorry for those who are raising their hands. We will have the opportunity to discuss the technical briefing, obviously, but I would like to take one final question from you, and then...
Thank you, Rebecca Christie from Bloomberg News. I actually had two questions. One is, would this proposal require any participating country to lower an existing tax? And the second question is regarding the U.S. opposition. The U.S. policy has always been to have as much liquidity as possible in the secondary market of U.S. Treasury securities trading, which would include trades, say, between two banks in the 11 member countries. That's part of the U.S. policy for selling their debt. I'm wondering how you plan to talk to them about that issue, and also what it means that you might be taxing sovereign bond trading in the middle of a sovereign bond crisis. Thank you.
Well, I think that it's very important point to ensure that the financial transaction tax does not lead to relocation of transactions, and that is why we have these very strong measures, anti-avoidance measures in the proposal. The proposal exempts the primary market transactions from the tax, but we discussed also the issue of the secondary market transactions, but according to our evaluation, actually an exemption of the secondary market transactions, bond transactions, would lead to distortions on the market and to unequal treatment of various products on the market. That is why the secondary market transactions, they remain as part of the tax base. And the first question was...
Would any country have to lower tax rates on any product as a result of this proposal?
The proposal clearly states that participating member states, they should not introduce any other taxes on financial transactions, and the proposal also foresees the minimum rates. So what we proposed, it's 0.1% on shares and bonds and 0.01% on the derivatives. These are minimum rates, and I do not recall any participating member state who has higher levels of taxes on these instruments, which will be subject for tax. But if this is the case, then of course, since these are minimum rates, so member states in question will have a right to keep the rate which existed in that member state before the tax is introduced.
Thank you very much, Commissioner, for coming to this press room and to present us this important directive. There is a detailed memo and a press release available outside this press room and on our website, so you can consult them. And again, there will be a technical briefing after this midday.